Yesterday's Fed minutes show that some Fed members are growing a tad hawkish, even talking about raising rates. Bob Brown, how much of a game changer is this?
You know, Greg, I would take the other side of it. I think there's actually more pressure to potentially cut back on the tapering in terms of the speed. Everyone's expecting $10 billion each FOMC meeting, and we actually think the potential pressures the other way is to cut back from that $10 billion forecast. We are concerned about the strength of the economy post the quantitative easing, and we are not as concerned about a significant rate rise as many in the industry are.
Talking about the strength of the economy, the Fed seems to think it's in pretty good shape, despite some really glum economic data we've seen during the first 2 months of the year. Do you think that they're overstating the strength of the economy?
Well, I'm not going to go into what the actual Fed is coming out with, but I can tell you Fidelity's point of view is we are definitely the glass is half empty with respect to the strength of the economy. We're seeing bits and pieces of some real estate strength, but at the end of the day, we're not seeing pricing power at corporations. If you look at the S&P 500 earnings and you look at revenues, they were not overly robust in the fourth quarter. So we're not seeing that pricing power. We're not seeing wage inflation. We're not seeing a lot of significant manufacturing hiring in the U.S. And we are very concerned about the overall strength of the economy. And look at the participation rate in the U.S. economy. I think it's 63%. So for the modern era, that's at an all-time low. We think there's plenty of slack in the employment scenario. You've got people working part-time. You have people that are overqualified. They're overqualified working in positions. So the 6.6% unemployment rate, I think, offers a lot of challenges in terms of the true strength of the economy.
So do you think the sub 3% yield on the 10-year is correct where it is? A lot of people say it's going to go to 3.5% by the end of the year.
Yeah, potentially. I think we're going to continue to see lots of volatility with respect to the 10-year. I had a conversation with a media outlet back in the early part of 2013, and I talked about the 10-year kind of being in that 2.5% to 3% range. We don't really see it that much different for 2014. Let's look at what would impact the 10-year. First, we have the strength or lack thereof of our U.S. economy. We've talked about some of the challenges there in terms of we're not seeing manufacturing hiring, sustainable manufacturing hiring. We're not seeing wage inflation. We're not seeing overall inflation, and we're not seeing pricing power. That does not spell to a significant, robust growth in our economy from that perspective. Then let's look outside of the U.S. You have deflationary concerns in the Eurozone. You have concerns over China's manufacturing strength. You have political tensions coming out of the Ukraine and Thailand. You have rising pressure in the emerging markets, Argentina, Turkey. All of those would, from our perspective, look to a flight to quality. Look at the 10-year year to date. It's returned about 2.5%. Who would have thought, right? Heading into the beginning of this year where equities were on fire, who would have thought the 10-year would have returned 2.5%? There's still a good spot for bonds in a well-diversified portfolio, and we think the 10-year will be somewhere between 2.5% to 3% for 2014.
All right, we're going to watch it. Bob Brown, thanks for coming on. And thank you for watching The Street.